In this video, we're going to discuss the fundamentals of understanding risk and return and how that impacts decision making. So let's first start with some basics, right? So in most decisions, there are two things we have to think about: risk and return. Now, there is actually a theory in finance that's referred to as the mean variance hypothesis. In the investment terms, essentially it says you can pick between any two assets if you understand its mean, its expected return, and its risk or its variance. So every decision has a certain kinds of characteristics that define its overall riskiness. So our job as financial managers and analysts is to determine what ways to quantify that risk and then how to use that making financial decisions. So there's two types of investment risk: standalone risk and portfolio risk. Standalone risk, I think, is kind of self-defining. It just talks about if an asset is sitting all by itself, what is its risk? Portfolio risk talks about what happens when we combine things. And this actually has a corporate finance context. A definition of a corporation could be a portfolio of assets. So understanding what happens when you add a new asset to a company is one of the aspects of decision making that managers have to think about. So obviously, investment risk is related to probabilities of earning low or negative actual returns. That's what's referred to as investment risk. When we think about risk in general, though, a better definition is it is the chance that something that you expect to happen doesn't happen. So again, this definition we can find here is it's the chance that what you expect to receive, you do not. You get something different. Sometimes that could be something good, and sometimes that could be something bad. But in general, when you look at risk, total risk, we're looking at a measure of uncertainty, right? So what about return? I think everybody understands the basics of returns, right? It is the gain or loss that you experience over time when you purchase some kind of an investment. It pertains to or is related to cash flows. Those cash flows could be regular, such as getting dividends, or it could be prices when you ultimately sell an asset. So total return can be looked at two ways. Realized returns are the returns you earn by holding but not selling an investment. The important part to remember about realized returns is these are not taxed, right? You don't pay a tax for capital gains until you actually sell the asset. The expected return is the return that you think you're going to get based on a risk-free component and a risk premium. So we need to analyze the riskiness of the project or the asset, combine a price for the risk with the risk-free element for an asset or the risk-free piece of an asset. Now, if we look at some returns over time, I think this is kind of enlightening, if you will. But think about this. From 1926 to 2019, if you purchased, and let's just start with United States Treasury bills down here. So United States Treasury bills, right? So on average, you'd earn about 3.4% a year. Standard deviation of that's 3.1. We'll talk about that a little bit later. So let's concentrate right now only on average returns. What if you invested in long-term government bonds? 6%. Now, in previous videos, when we talked about interest rates, what's creating this difference? If the United States Treasury securities are risk-free, the difference between these two things has to do with market risk premium, or maturity risk premium, excuse me. Long-term corporate bonds, 6.4. It has a higher average rate of return than government bonds. What's the difference? Default risk, potentially liquidity premium. But let's think about stocks right now, because that's what everybody wants to talk about. Between 1926 and 2019, large cap stocks earned around 12.1%. What are large cap stocks? Think about the S&P 500. On average, that has earned roughly 12% per year every year. Now, when we talked about time value of money, some other issues along the way, one of the things that we've talked about is the idea that this is an average. You're not going to get 12% a year, but over a long period of time, you can earn those kinds of funds. And in fact, this is what's happened over this roughly 93 odd years. Small cap stocks got 16.3%. Why is that? It's because small cap stocks are riskier than large cap stocks. And that's really part of the discussion in this particular chapter. So let's move on and talk about, again, a later part in the video, we'll talk about portfolios. So we have 90% stocks, 10% bonds. You're around 11% return. 17% is the risk. 70% stocks, 30% bonds, 10.2, 14.1% risk. So again, we're going to explore this relationship and how these things work. So let's start talking about calculating returns. And the first thing is something referred to as the holding period. Now here's our formula. It's just the cash flow plus some form of price at the time t divided by the price at t minus 1. So another way of thinking of this, just so I can do it, is this is the ending price and this is the beginning price. Right? This is the cash flow during this time frame. Now, it does need to be adjusted for annualization if you have a time period longer than a year. So let's think about how this might work in an example. So we have some stocks in Microsoft and we have some stocks in P&G. So what we can see is $73 is what we paid for Microsoft. At the end, it was worth $106. We received some dividends, $1.65, and this is 1 year. So in this year, it earned 47.37%. Pretty decent return for 1 year, I would think. Likewise, we do the exact same thing for P&G, and you can see that P&G went from $92 to $80. It did pay $2 in dividends, so it has a negative 0.3% return. Since these were 1 year investments, we now also know that the annual return, annualized return, and the holding period return are the same. So let's continue on. How can we do this, or how can we measure these returns for some form of asset? Well, there's two things we have to think about. We can do historical analysis. We can look at the rates of returns over the last 5-10 years and average that arithmetically. Or we can predict moving forward. So this is what we refer to as the expected return. It's the sum of all of the rates of returns multiplied by the probability of their occurrence. And we'll talk about these in a little bit different. But one thing we have to understand is we have to estimate two things. Number one, what do we think the return will be in the future? But we also have to understand or analyze what do we think the chance of those returns are. So standard deviation is a measure of risk, is the measure of standalone risk or total risk. So our formula starts to get a little bit more complicated, but all I want us to think about for right now is our definition of risk. Risk is the chance, that's probability, that the actual rate of return, R sub j, is different than the average. We expect to get the average rate of return, but we have predictions that it could be different. And obviously, we still have a historical number. So in general, the higher the standard deviation, the greater the risk. In addition, we have something referred to as the coefficient of variation. Now, this is a relative measure of dispersion, right? Standard deviation measures dispersion. That's the statistical term, how things are spread out. Coefficient of variation measures the relative measure of dispersion. You take the risk, the standard deviation, and you divide it by the expected average rate of return. That gives us a number, if you will, of how much risk, standard deviation, do you get for every 1% rate of return. So how do you predict probabilities? Lots of different ways. I think one of the best ways to think about this is to think about predicting GDP. Create some kind of a table that represents good to bad. Take a survey, see what people say, and analyze that particular frequency distribution for what people think is going to happen. Now, we have some assets here. We have probabilities, right? This is the probabilities that we've gotten from our survey. And now we have 5 assets, T-bills, high tech. These, I believe, are collectibles. This is rubber. I forget what MP stands for. But these are 5 different kinds of assets. So we want to think about T-bills first. What about Treasury bills is so special? T-bills are considered to be risk-free investments, right? So they're going to return a promised 3% regardless of what happens. That means that identifies them as being risk-free. Now, they're not totally risk-free. They do have some risk elements, but from a default perspective, T-bills are considered to be risk-free. The United States government will never default on its debt. So let's look at a spreadsheet and how we can calculate these things. If you create a spreadsheet that has probabilities, here's where you would put the returns. Now, these are not prices, these are returns. We can then input our formulas. Here are the Excel formulas for these line items in our analysis. So let's see how this works for 3 of our assets. So here's the probabilities that we came up with. We have a risk-free rate of return of 3. The asset A, here are the returns, asset B, asset C. So let's look at the statistics. If you look at the expected return, right, this is the average rate of return, 9.9 for A, 8 for C, and B is 1.15. So obviously A or B is the least risky, A is the is the lowest return, asset A is the highest return. Let's look at standard deviation. This is our measure of total risk. Can you see that A is 20%, B is 11%, C is 15%. So again, they seem to be in the right order with respect to returns and risk. Coefficient of variation, 2%, 2 for A, 9 for B, and C is 1.8. So this changed our picture a little bit. It says, look, really, If you look at relative risk, asset B is much riskier than the other two assets. Now, there is a ratio that's referred to as the Sharpe ratio. This is just kind of a performance measure. The bigger the number, the better the rate of return. Essentially, the formula is it's the return of the asset minus the risk-free rate. So it'd be 9.9 minus 3 divided by the standard deviation. So this tells you how much extra return you got by buying something risky, divided by the actual riskiness of that asset. The higher the number, the better the performance. So we're going to look at some different assets, how we can analyze this information as we move further in our future videos.